Hello, everyone. Welcome to the podcast Trading Patterns. My name is Dmitry Kirchev. I'm going to be your host, and with me is Mr. Nikolai Stoykov. Hello, Mr. Stoykov.
Hello, Mr. Kirchev, and hello to our lovely audience.
In today's episode, I would like to discuss deep knowledge. A lot of us seem to talk about things or do things we don't have a deep knowledge about.
Right. I mean, first it starts with the idea that deep knowledge is not necessary. Or at least it seems like it might not be. I mean, think about it. Like your idea about what knowledge is and what deep knowledge is shaped by school, and you pass through many classes, take multiple kind of subjects. And sometimes, like, some of them attract you and some of them they don't. And you rarely explore the ones that attract you, and you're kind of forced to take subjects that you're not interested in. So we kind of get the sense that, listen, I could pass, could get good grades without actually liking the stuff that I'm taking. And maybe I could get away like this in my life, in my job, not kind of remembering things after a year or even after a month. I mean, people forget a lot of the stuff they take in school. And that's not deep knowledge. That's very superficial knowledge. Let me give you an example. When I first got into trading, imagine I'm a very good student. I've taken a lot of like financial and statistical and math classes. And I've went to like a training class, and I've been trained for a year by my supervisors or several people at the company I was working at, Susquehanna at the time. And when I got to the floor of the American Stock Exchange, people would call us newbies, sheet monkeys. And I took great offense to like being called a sheet monkey, but in reality I was. Let me give you an example. Let's say that you actually come up with some great idea to be long short a stock, and you find it like statistical correlation very high, and you figure that one stock is a buy and another stock is a sell. You are very smart that way, in that particular sense that you're independent of the market, and those two stocks behave in a very kind of similar way, and one of them is just slightly more expensive than the other, and you decide that this is an arbitrage opportunity. Lord and behold, the company you short actually gets taken over. And that's a sheet monkey trade. That's a sheet monkey trade in the sense that it looks great statistically, it looks great from some sort of a statistical point of view. But life is full of surprises, and you're just trying to be a little bit too smart. And you don't know those companies. Like, the most important thing is the reason why you did those companies is because of statistical kind of parameters showing up. But you actually don't know them. You don't know those companies are just a ticker for you. You don't know what their prospects are. You don't know which company is better than the other. All you care about the relative price of one versus the other. And accidents like that tend to happen when people really don't know the things that they're about to trade, or they actually have traded.
You studied statistics, right?
Right.
Do you think that contributed for the development of your career?
Yes. It's I have really thought about this a lot, and decided that the main impediment to kind of making successful career in finance, at least, I don't know about any other careers, is people's inability to think probabilistically. And we see this every day. And I was kind of stumbled into a degree in statistics by accident. I was a freshman in college, and the statistics department needed a teaching assistant. And the teacher asked me, she must have seen something in me, and she asked me to be a teaching assistant. I deeply very well remember the conversation we had, even though that's 20 years ago. I asked her why, Carol. Her name was Carol Marchetti. And said, Carol, I'm a good student. I'm a very good student. But I'm young. And there could be other students that are equally good. And she said that there are many people that understand statistics, but very few that can actually explain it as well. So that really helped. It really helped. That really helped me in my career path. And it's not necessarily like something that if you don't have, that you greatly miss or something you can't catch up. But in my experience, it's very important. Being able to run the statistics in your head. I'll give you an example. We have questions we usually ask candidates. And one of the questions towards the middle or the end is if you flip a coin 20 times and 20 times the result has been heads, what would you bet? Would you bet are you going to bet, can you bet tails? Are you willing to bet tails? The tails going to show up? And this is a very simple question that's from probabilistic point of view. Reality is if the coin is fair, 20 times in a row is a 1 in a million event. And most people, I could see it in their eyes, like a cloud kind of covers them. They're trying to kind of calculate it and stuff like that. And even if they calculate it correctly, they don't know what to do with it. And the answer is very simple. If what is occurring is explained by only a 1 in 1 million probability, what you're observing is a fraud. So the only, practically speaking, the only time that a coin's going to flip 20 times heads is if two sides are heads. It's very simple, kind of like something you'll pick up from statistics. But people don't like to think about it. They fall into a pattern that they've read in a book. If you flip a coin and 3 times it turns heads, doesn't mean it's going to be heads. It's 50-50 heads on tails.
Oh yeah, aren't they independent?
They're independent.
Yeah.
But independent. But if they're independent events, 20 times in a row means 1 in a million. And this is the kind of things about deep knowledge. It's like deep knowledge is very difficult to acquire. And it's like practically you're going to walk into a lot of situations where not only the probabilities are not easy to calculate, you're going to be deceived by the possibility of those probabilities.
Would you give us a real-time example, like anything that could explain to our listeners the importance of probabilistic thinking?
Right. Let me give you something that I read in the newspapers. We were laughing with my colleagues at my previous job. We're trying to, bear with me, I just read it in the newspaper, so trying to kind of figure out exactly what happened. But the idea is something like this. Out of town, a foreigner goes to New York and drops by at the lobby of the hotel, and an attractive blonde accosts him, and they start flirting. And
is that a real story?
Yeah, and she, they go to his room, and as they go into the room, her boyfriend comes in, they jump him, and take all his money, phone and a laptop, and the reality is, it's very difficult to kind of be independent and say, hey, attractive women don't really accost you at the lobby bar of the hotel. And you don't know that person. And it seems like, she's willing to fulfill your dreams. But how many times has that happened to you? How many women have accosted you at the hotel bar? How many times has that happened to people around you? And it's a pretty rare event. And
would you consider that to be 1 in a million?
It's probably not 1 in a million, but there's different degrees of statistics. When it's 1 in a million, the proper conclusion is, look, something's very wrong. this is a fraud or something is like, completely off the charts. If it's a 1 in 100 event or something like that, usually something else explains what's happening. So in the sense that like a blonde walking into you and it seems like she's willing to fulfill your dream right away. This is a very unusual event. It's a very unusual event, not 1 in a million, but probably like not more than 1 in 100. And something else happening. And this is the difference between a sheet monkey and an experienced trader. A sheet monkey, like a brand new trader, he's going to walk into those traps. And don't be surprised if you find yourself completely naked or just with your underwear in bed.
Strapped to the bed.
All your belongings taken.
So basically, the analogy with the blonde woman in the bar, you connect that. You make the analogy with the young traders in the financial market.
That's right. It takes a while. I mean, practically impossible to kind of completely miss some of the traps that markets do to you. But eventually, you kind of begin to discern a pattern, hopefully. And one of the patterns that really prevents people from kind of being able to, I guess, enhance their career, really take it like further, is their inability to distinguish what's an integrous teacher or what's integrous kind of like a strategy. One of the things that kind of like pops in my mind is Madoff. And I remember that I was working, my mentor at the time, like my boss, he told me about Madoff. And then he said, like the strangest thing, he said, but, he has supposedly very good returns. But the one thing that's very strange is that he doesn't raise public money. He uses like outside solicitors or people other than not officially associated with himself. And I don't know what to make of it. And I didn't realize how important those words were. It's like if somebody is really good trader and has a really good track record, the natural thing for him is to raise outside money.
Make it public.
And if he doesn't, how rare is that event? And with experience, I can tell you that's 1 in 100, or even rarer than that. It's just, and once you begin to see the pattern, all fraudsters, all kind of like, non-integrous teachers tend not to have a public track record. And how important that is to actually verify or not. So if you buy a book or you follow somebody that supposedly is a great trader, supposedly worked at many different firms, that's a very similar situation to the blonde walking up to you in a bar. And don't be surprised if all your belongings are gone.
Throw back to Mr. Minervini and Jim Simons. We discussed
and all the likes. So the important thing here is to say that this is a pattern. We don't really know anything more than the public knows about any of those people. We're just pointing out that, there is a pattern, and this pattern is exhibited as Mr. Madoff. We find, or at least I find, a lot of similarities between not just the names you mentioned, but the many people that publish books and kind of like create some sort of like a traders university courses that you're supposed to take and follow. And and the reason why many people don't recognize it is because you're a sheet monkey.
Okay, next question, Mr. Stoykov. Have you watched Suits?
Not really, but...
you know the idea of it?
Yeah, I know the idea.
Okay, so the main character, Harvey Specter, the big shot lawyer, the best closer in New York, he tells his mentee, Mike, you don't play the case, you play the man.
Right.
Okay, so from your perspective, do you think traders should, instead of trying to analyze common equity, should they dissociate from that activity since there's so little information that can be found? Should they instead pay more attention to the owners of the company, to the board of directors of these companies, to the corporate structure of the company itself?
Yes. Yes, that brings another blonde woman in the bar episode. A real case. A company stock has gone up 500% in the last year. It's some sort of a technology company, doing something in robotics. And people are very excited about it. And you begin to do your research and kind of like understand that, okay, companies forecasting 400, 500% increase in profits within 2 years. That's good. That justifies the price. But this is where, the shit monkey ends. And this is where, the person that has met the blonde in the bar goes on real work. You go on the website and you research the management. And it turns out that the management is 6 kind of people. And out of the 6 people, 3 don't list higher education. It's like they didn't graduate from home university, and only 2 are actually engineers. And you begin to scratch your heads. It's like, are those people qualified? And then you do further research, and it turns out that the company hasn't hired any people in the last 2 years. I mean, the headcount is virtually the same.
Talk about red flags.
And multiple red flags. And people will say, well, but Nikolai, the company could still do what it says it does. And I'm like, yes, that blonde woman that's very friendly with you at the bar really can make you happy.
And she might touch your shoulder when she's talking.
That's right. That's right. But in reality, my experience is that they may not. They may not. And those are little things that kind of resonate. I mean, if a person is very interested in trading, he'll try hard and do many different things. This is a real example, another real example. We had an employee, and we basically asked him to do some Excel spreadsheet. And he produced the Excel spreadsheet, and all the information was there. But it wasn't well presented. So we went up to him and said, look, this is going to be presented to various people. Let's make it look pretty, very pretty. And he said, what do you want me to change? I said, I don't know what you can change. Just think about it as if a very attractive woman is going to see that Excel spreadsheet, and there is a chance that she'll please you orally. Right. People there's a difference between effort and going without sounding like a cliche, way and above the effort. And I could see in that company, maybe it has some sort of a prospect, but I don't see those people capable of going way and beyond the effort, potentially, especially with the fact that they're not hiring any more people. I mean, that's a huge red flag. Usually things like that don't end up well, in my experience.
The problem is that a lot of traders just look at the price. All they look at is the price.
That's right.
Yeah, maybe that's going to fit my analysis.
Right. Trader starts with the idea of the dream. It's living the dream, things like that. And the dream is only one. As we said, it's girls in bikini and a Lamborghini. And surprisingly, he is not willing to do quite a few things. In the sense that he reads about this, that look, an equity analyst actually begins when he begins his career on Wall Street, covers maybe 5 or 6 stocks, or even starts with 2. A very experienced equity analyst with maybe 20 years experience would have 20 stocks to cover. And somebody like Warren Buffett, that's been investing in the market for 70 years, maybe knows 100 companies. And trader is just willing to jump shit and go from a stock to stock,
100 stocks for today based on alerts.
And the idea that I can make money. And you could make money. But what you're reluctant to do is acquire deep knowledge in those companies. And it's just something that's very unfortunate. First of all, deep knowledge is very hard to acquire, even if you make the commitment that you want to acquire deep knowledge. But the vast majority of people are just reluctant to stick to any particular set of instruments or stocks. They want to have the freedom to like float from one instrument to the other. And in my experience, that doesn't translate into a successful career.
Do you have any statistic when it comes to traders? What do you think is the percentage of them actually consistently beating the market?
That's very difficult to say. In the sense that many people use leverage, use different strategies, and kind of like people go here and there, hedge funds come and go. I tell you the one interesting fact that when I was working at one of the hedge funds in New York, we had a compliance officer, and she said something that really kind of, I didn't understand the importance. She said, if you consistently make money in stocks, the SEC is going to come and investigate you.
By make money in stocks, do you mean like beat the S&P 500 or?
No, just make money.
Wow.
Make money.
Okay. Game isn't rigged.
and like, I guess the reality is that it's true that like, I mean, Stevie Cohen got convicted for insider trading. It's like people that really show good returns trading stocks. History says that usually they trade with inside information. That for sure we could say that majority of the people, especially like hedge funds managers or like large money that tend to be in the market for the long run, tend to be involved in more fixed income securities. Stocks seems like knowledge very difficult to acquire, and stocks are actually kind of like a very subject to sentiment. In the sense that when institutional investors are underinvested in them, and if they decide to invest, they could go up a lot. But if they're overinvested, maybe there's only downside. And those kind of money flows are very difficult to gauge, and they're unpredictable. And sentiment changes, and that could be very difficult to gauge.
So the stock market requires deep knowledge, most of the traders don't have.
Right. I mean, the important thing is that we don't pay attention to that. Like Warren Buffett is a statistical outlier. What he says is that there could be whole sections of the stock market where deep knowledge is impossible to acquire for many stocks. For example, technology or biotech stocks. In the sense that you could trade them using some sort of trade signals, but in reality, don't expect to be consistent, or very few people can expect to be consistent. And tendency to like use some sort of more conservative valuations for the broader market is probably where a lot more people have found success. So if you're trading Tesla, that's great. But my experience is that with the valuation so high, you even if you're successful, it's going to give you the idea that you could trade any security regardless of the price. And Tesla is at the levels that are very difficult, I would call investment attractive levels.
Yeah, that seems to be the case with a lot of stocks recently. Like there's been a lot of public hype pumping stocks. It was the case with GameStop. Yeah. It was the case recently with another stock that just
HKD.
Yeah, HKD. Yeah. From what, $10
from like $7 or $6.90, something like that.
Yeah, something like that. It's north of 2,500. So.
That's nice if you're alone.
If you're alone, yeah.
it's very important to keep in mind that we have a saying here. It's like, this is like we have a risk department, and risk department's actually quite fun. They say your best month is usually followed by the worst month, and this is like what traders don't understand. Like, even if you're long that stock, let's say assume you bought it at 10, and I don't know, you got out at like 1,000, which is quite unrealistic. But let's assume that you did. You know what you're going to do then next? You're going to look for the next stock that's just going to do just like that. And you're just going to throw the dart. So the reality is, even if you get like some sort of a very lucky break in one of your positions, your tendency is to actually overbet, over leverage.
Try to replicate what you did.
That's right, for the next trade. And this is like practically guaranteed, like your best month, especially if you're a new trader, what we call sheet monkey, or what they used to people call sheet monkey. And that's practically guaranteed. Your best month will be followed by your worst month. And that could be repeated a few times before you manage to moderate it.
Or have it moderate, or the market to moderate you.
Yeah. Yeah, we don't know. People do learn. So like after a few times, people usually moderate.
Active or passive management? S&P 500 or day trading stocks?
That's, the important thing is that we don't have like a very deep knowledge of this. And
just your opinion.
Yeah, just my opinion. Right. What we could see is that active traders have underperformed passive traders in the long run, that's for sure.
Yeah, in the long run, talking about the long run.
In the long run, that's for sure. It seems like active trading requires tremendous concentration. It does require tremendous concentration, and it requires you not to have drama in your life. And that's very difficult to achieve for your career. Some things go wrong. The other thing that tends to occur is that you're capped at some sort of a size. If you're an active trader, it's very difficult to kind of gauge what the liquidity will be if you become too big. So returns could be very attractive, but at some point the liquidity might not be there for your strategy, and you always worry about that if you're an active trader. It seems like what's necessary to be a patient or long-term investor is not just to be patient, but actually be right. And that's very hard for people to accept, that there are people that are right about the market. And there's different levels of rightness. Nobody's perfect on the market, but being able to make forward distribution of this stock is probably gonna be between 50 and 100% higher within the next 3 to 5 years, and be right about a lot of your forecasts. That's possible, and people do it. It just takes a lot of experience. And what usually prevents people from doing something like this is they're active traders, and they say, "Hey, I need to extend my kind of horizon." And instead of trading on a daily basis or even a weekly basis, they say, "Okay, I'll trade for 6 weeks," and that's just not enough. And once they kind of begin to underperform their strategy that's actively trading, they kind of give up. But yeah, there is reason to why passive investors tend to stay a long time, and a trader eventually will have to extend his kind of range of holding trades on an annual basis. So at least
annual basis.
Yes, at least a year, maybe 2. This is very hard for people to accept, that a trader is really no different than a farmer. For reasons that are unbeknownst to me, or maybe just because intellect is actually quite arrogant. A trader thinks that he's so much better than a farmer. He's so stupid to bet a lot on kind of crop and just plant it and hope it grows. And trader thinks that he'll be able to jump from stock to stock, from trade to trade, and achieve results that are a lot better. And that's possible, but very few people could do it. And there's something to be said about kind of like actually planting a tree. And tree takes a long time to grow. It doesn't really grow within 3 weeks or 3 months. It takes years. And many traits that passive manifestors do extend like multiple years. Sometimes even more than 3, 5, or 10 years. And people don't have the patience for that. They come up with strange kind of explanations for, something could happen. Something could happen. Something could happen. But the farmer really would like not to risk it all. If he sees a black cloud, he would like to take his crop out of the ground and store it in a warehouse. But he can't do it because, first of all, the cloud could pass. And then even if there is cloud and it begins to rain, the damage from taking the crop out of the ground could be a lot worse than the damage from the black cloud. And
so just plant the seed and just wait it out.
Yes, I mean,
with the storm.
Yeah, this is something that the trader needs to do eventually. Everything has a purpose, and the purpose of the trader is not to have as much fun as he want to have, as much sex as he wants to have, or as much as Lamborghini. It's actually to provide something useful, and it's something. It brings you up. Like, you know, I spoke about this in one of the previous episodes. I had a colleague of my father. And my father had passed away 6 years ago, and he came up to me and said, "Nikolai, here's kind of my retirement money. I want you to have it, and I want a little bit of return, not a lot. And just..."
What's a little bit of return, by the way? Is it like beating the inflation?
Yeah, he's kind of beating the inflation. He's not looking for 10 or 15% return. It's like, let's say, 5% return, something like that.
Yeah.
After taxes. And it just kind of like made me revisit everything like in my career and everything I know. And people say kind of crossing the T and dotting the I. I tell you, I kind of looked at a lot more than that. Like, I looked at many blondes approaching you at the bar. Could I be deceiving myself? Could I be self-deceiving myself? How realistic is my distribution going forward? For the next 2-3 years. And that was a real exercise in kind of like what you believe. And you always kind of like reluctant to take such a responsibility because, if something happens, this person could die. I mean, it's all fun and games. It's all girls in bikini in a Lambo. But at some point, because of your decisions, somebody could die. Could you live with it? And it's at some point, you need to take responsibility and kind of say, this is my best case. And even if you refuse to take a responsibility, what is this person going to do? He's going to walk into somebody that's like a sheet monkey and he's going to put him in a stock that's probably has incompetent management.
Yeah.
So, at some point, I could have made a mistake, but based on my experience, I don't think I did make a mistake, but the future is still uncertain. So, yeah.
So I take it he's not invested in common equity.
It's a mix of things. He's not. It's not like it's not common stocks, but he has some sort of equity-like exposure.
Okay. One last question. You mentioned earlier something that really got my interest, and I think a lot of people.
Girls in bikini and a Lamborghini.
Okay, no.
Besides that.
Yeah. Besides that. You mentioned insider information, trading on insider information, hedge funds that are relying on inside information to trade successfully.
Okay.
Is insider information a recipe for success?
It's a very good bet that it could be. We really don't have a lot of data, but it depends on who provides you the information.
I mean, I guess the information itself needs to be material.
Right. It's we were joking that like even if you kind of know that a company's earnings are going to be better, let's say that that's actually inside information. If the company guides down, that could go down. The one very important inside information that seems to be consistently making money is the one about pending transactions, takeovers, and mergers and acquisitions. So this is very lucrative kind of. Potentially, it's of course it's illegal, but people that where inside information is very useful is precisely in situations like that. Having like the earnings or getting on people could kind of guess the earnings of a company. There is all kinds of like businesses are built around it, where people could try to verify like the earnings of a company. But what we don't know is how the company is going to guide. In terms of like the development projects and things like that. So in terms of like getting inside information or getting some information from competitors and trying to gauge what the particular company does could be useful, could be not. But it seems like the information that most people kind of want it seems to be prized if you're involved inside trading. That's merger and acquisitions, takeovers. Earnings may or may not be that material, and people kind of guess. There is, if you possess a deep knowledge of the company, you could estimate a lot of things that are not necessarily known to the public. But a lot of people could do that. It takes an effort. So a lot of people could guess earnings of a company well, not perfectly. But what truly nobody knows is merger and acquisitions, and that's actually quite valuable. Again, this is illegal, but it seems like that's what.
Okay, now that you mentioned the illegal part so many times, there's no way I'm just gonna go around that.
All right. You want that? You want to get in that business?
Well, why not? Another question about insider trading. Let's say that there is a insider information about the merger and acquisition of a company that an analyst follows. And let's say that he buys a particular number of stocks.
Mm-hmm.
He buys the stocks, the stock price goes up. Is he going to be necessarily visited by the SEC?
Yes.
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 Even if he just buys stocks?
Yes. And this is a real case. Like we had an employee at our first company that basically hadn't declared his brokerage account and he was trading. And the SEC did some sort of a random check on our employees.
A random check, just like that?
Just like that. If they've registered the account and the account hasn't been registered, and he got fired. So you're supposed to declare all your trades to your employees. It's not illegal. It's a practice of good governance, in the sense that many companies do it. Like, you're allowed to trade, but you have to kind of tell people that you're trading. And if you're some sort of like a regulatory company, like a bank or something like that, the SEC could actually do some sort of a random checking and see if you've actually declared your account and if you're doing authorized trades. Yes.
So it's not just options; it's stocks as well.
Yeah, stocks as well. I mean, people usually kind of like open the account in somebody else's name, kind of like their cousin or their best friend or some sort of uncle or whatever. But surveillance or some sort of kind of enforcement of those insider trading rules are actually no joke.
Okay. Thank you very much for the information, Mr. Stoykov.
Right. I want to thank you, Mr. Kirchev, and thank you for our audience, and I hope you enjoyed it and speak to you again.
Yeah. See you in the next episode.